Hey folks, it's April 11th, 2025 here on a wonderful Friday. And here again, James Griffin and Nick Murata to talk a little bit about what's going on in the markets today. Just a couple pieces of information to get us started here. Our market indexes are parts of the market year to date, or let's say from the high. So I think the high, what was that, Nick, around the 19th of February?
Yep.
Pretty close to that. S&P 500 down 17%, but we're up from that negative 20 point. Sorry, growth side, the S&P 500 down 17%, S&P 500 down 14%, value down 10.5, and bonds are about flat, down 0.3% for the year. Still doing what they need to be doing and staying somewhat flat. And we're going to talk about navigating turbulent waters here. I do see a ray of light at the end of the tunnel there, though, Nick. I like that. I like AI. Like, it looks pretty rough out there, but there is a ray of light. And I think in the spirit of having some fun, we've mentioned the word tariff a lot in the last week, probably more than I have in the rest of my life. So today I'm going to try to talk about tariffs as foreign goods surcharges. So
That's a mouthful.
we're just gonna cut that down to FGS. That's the what we're gonna do. So, anyways, let's get into it, Nick. Talk about global markets here. So, what has happened here? Obviously, just recently, there's been a 90-day pause put into um, new foreign goods surcharges across the globe, and what we found here is that right now we're going to do a 9-day pause. They're still kind of talking through negotiations for a broad-based 10% tariff, but there is that special country, and they're getting a special deal for now, at least. And so I think that's that's really what's going on here. Nick, what do you think about these negotiations? I mean, what are the likelihood that we can get this thing knocked out in
Well, that was the
nine
hope
days?
was that the initial starting rate from what was announced on April 2nd, that we would come down in terms of negotiations and come to some middle ground. The 90-day pause, it does not mean we're out of the woods, but at least gives us a little time to breathe overall. The more difficult or the escalating trade war is China, and they do not seem to be willing to make a deal, and that one may be more difficult. But at the levels they're at now, there would hope to be some kind of compromise at a much lower rate, which would benefit both countries and together as well. So the pause, we don't really know if it was strategic or was it from pressure from the markets overall, the market being down 20%, the bond market showing some instability overall. So was it forced or was it strategic? We don't know. Either way, the 90-day pause does give us breathing room, and hopefully some negotiations continue there overall. But like I said, we're not out of the woods yet.
Yeah, I think the thing I've heard a lot here lately is this time it's different, Nick. It's different this time.
Always,
And it is
it always
different,
is.
right?
It always is. Yes.
But what's the same? What do you think is the same?
Well, the same as every down market in history, whether it be COVID, the Cuban Missile Crisis, World War II, on and on and on. It does end at some point in time. The pain ends and results in the market going higher. The question is, does this push us into something bigger, or do we get quick resolution and then we bounce back? The tough part is capital and consumers are a little bit on hold because we're caught in the uncertainty, and CEOs and CFOs and how they plan their global companies are basically taking a pause. I mean, what we saw Apple fly in 5 planes or 600 tons of iPhones to try to get in front of this, and corporations are smart and they'll make changes overall, but there needs to be some certainty to kind of make a commitment to an overall change.
Yeah, absolutely. I mean, obviously the tension between US and China You know, thinking through all the infrastructure they have in place as far as factories and systems and skilled workers that do certain things. You know, you just think through that supply chain of all the many things that could be disrupted for not having a deal or coming to an agreement somewhere. So obviously, there's a lot of ripple effects there. Not, it's hard to say how far this will go. I know it's going to impact everything directly, but you know, what's to say that China won't start shipping things to other countries we have deals with? I mean, maybe that's part of this negotiation to prevent things like that from happening. But um, you know, it's a lot of uncertainty for sure. Let's talk through
Yeah.
inflation. Yeah, so obviously many points of inflation. And inflation really, I mean, to me, inflation impacts growth. And you know, you think through simple things like home improvement projects, maybe landscaping, or maybe you have a vehicle, it's a little older. And, you know, if the economy's moving along, the wealth effects there, your portfolios are up, you're more than likely to make more of a bigger decision. Maybe we remodel that, we add the room, we put in the new trees, we replace the vehicle. But, you know, talking to more and more people, if this were to linger on too much longer, you know, instead of putting in the extra room, maybe it's a fresh coat of paint. You know, instead of getting a new vehicle, maybe we're going to fix that oil pan gasket that was dripping a little bit on the driveway. So let's talk a little bit about the inflation risk. Nick, what else do you see there?
Yeah, I mean, it's definitely puts pressure on inflation from a good standpoint, right? CPI is not just consumer goods. It affects a lot of different things, and a big portion of CPI is shelter and energy. And you know, energy prices have actually been going down, and so that's actually somewhat got a downward effect on CPI. And shelter really hasn't rose all that much. I mean, house prices have been kind of stagnant to slightly down overall. Um, and rents have kind of rolled over. We saw rents tick up a little bit last month overall, but we just got a CPI report and it was actually much better than expected. The market doesn't really care about that now. I think normally the market would have kind of like, oh, that's nice because maybe the Fed comes in and then starts decreasing interest rates because they have the inflation mandate. But market doesn't care about that. All the market cares about right now is tariffs and the certainty around tariffs. So it's still yet to be seen. Yes, goods inflation for sure, but if we have a slowing economic, economy, then there'll be other things that kind of push down inflation. So where that balances out is still yet to be seen. But we're going to see a lot of telling information probably here. We're entering earnings season, and CEOs are going to be giving their earnings, and we don't expect bad earnings for last quarter
Hmm.
necessarily, but their outlook is just going to be uncertain. I mean, no one's going to be painting a pretty optimistic outlook at this point because no one has the certainty to do that. So I think there's going to be a lot of pulling forward guidance, uncertainty, those kind of thoughts overall, and pressure on margins.
Absolutely.
So I can talk a little bit about this one. So, you know, when was it just Wednesday? I feel like I've worked for like 3 weeks straight, but just Wednesday, we did the 90-day pause, and there was some early warning signs. People look at the stock market, but we look a lot at the bond market. The bond market is way bigger than the stock market. It's structurally important for the free flow of credit, to make sure financial stability and everything is functioning properly. And bond yields increased overnight pretty significantly for a 1 day move. And that could be because Japan or China was selling treasuries. There's speculation there overall, and that the US is not seen as stable as they once were for kind of foreign money. And so that started to pop up. And once the announcement was made of the 90-day pause, that kind of immediately went back. So did that kind of push the administration, along with some other things, maybe to say, okay, well, let's take a breather here overall. One thing the market's been talking about, so that's the Trump put that we've been talking about to clients, that the news stations have been talking about, is that at some pain point there, it puts so much pressure that there's potential changes that occur. And the market has a good way of doing this. They did it in 2018 when Powell was actually raising interest rates, and the market let it known with a 20% decline in about 2.5 months, and Powell backed off basically. So the Trump put, we kind of know where the breaking point may be in terms of saying, okay, we need to negotiate even more or have an additional pause or whatever it may be. So that's kind of where we're at from the market perspective. We're probably going to be more of in a range unless we get some good news in terms of certainty. And then eventually, potentially, there's a Fed put, but we'll have to see where inflation is. Like the Fed wants to cut interest rates, but they have this dual mandate of inflation and employment. Employment still seems to be pretty good. I haven't really seen too much cracks in the employment market. So it really comes down to inflation. And if they can decrease interest rates, obviously that helps things out as well.
Yeah, I mean, we had talked about this in the 2025 market outlook about volatility. I think that the framework from the last 2 years going into 2025 set us up for a year of volatility, regardless of, potential talks around tariffs to this extent. And that's obviously been elevated, right? So Wednesday, the volume and volatility on Wednesday was one of the highest recorded volume days as far as advancing declining in history, second highest, right? That's crazy.
That's unreal. Yeah, second highest. The first highest was actually in 2018 that I just mentioned, was when Powell reversed course on interest rates.
Yeah. Sentiment extreme. So if we were to pull up a daily sentiment composite, uh, people's fear level is higher this week than what it was at COVID. So to put things for perspective, right? Like at one point, like people were concerned, like, hey, we're going to be stuck in our house forever, and is there going to be a cure for this, et cetera. And this is just around global trade, so it's pretty monumental. On the one side, just from a investor perspective, we've seen this as well. We've seen huge down days. We've also seen a huge up day. So it just kind of goes to show that some of the previous slides we talked about in previous videos, by getting out in the bad days, they're typically followed in some form or fashion by a large up day. And that can be a huge problem. It's an irrevocable decision to completely get out of the market during some of those days.
Yeah, and what it made it such a big update is that we were at such extreme levels of pessimism. It wasn't that there was such great news on Wednesday. It was just news that they were willing to make some changes and that the administration wasn't going to be persistent with, playing, hardball, I guess, if you will. So that kind of pessimism and probably short covering as well really led to a big up day. So it was an over a 10-to-1 update, 151-to-1, which seems even crazy to say. Yesterday was more than a 10-to-1 down day, though. So we go back to our recovery framework. We posted a video on, I want to say 3/13, or maybe it was a little bit later than that. I think it was towards the end of the March, about what the market typically does when looking for a bottom. So we start with an oversold condition, which obviously we had oversold condition, extreme pessimism, and then we have potential rallies. And so that is the normal process of bottoming out, that we have an initial rally, big up days overall, but usually those up days kind of are mitigated over the course of time. And then, the people that want to sell before, then sell then, and then we usually retest our lows in some form or fashion. So this framework is happening I made this deck on Wednesday, and we're already probably in between step 2 and step 3. Like I thought we were in step 2 in the rally stage and hadn't had a retest, but we're already having some retest overall. But this is on a very short-term basis. So this volatility is probably going to continue until we get some certainty. And then even once we get certainty, we have to see what kind of the collateral damage is potentially done. But if we do come to a fair, agreement that the market feels acceptable, then I think we may not get to our all-time highs anytime soon, but we'll get some more balance overall. And then we look for really broad conviction buying, multiple up days, multiple advancing volume over declining volume. And at this point, we really haven't seen that. I think we've only had one up day out of 6 last days.
Yeah, so I think big picture, expect volatility. Obviously, the uncertainty feeds the trading volume and big ups and downs. Just from an investment perspective, one of the things we're talking about, obviously, staying diversified and staying away from that irrevocable decision, sliding one way or another in your investment policy or risk level, can be a good way to take advantage of opportunity, but be careful with big moves that could really impact, the long-term future. And Brad Klontz and Dr. Brad and I talked about this earlier. I want you to detach from what's going on right now and look forward 2, 3, 4, 5 years. And that future person, think about what they're thinking about you today. Are you making sound decisions, getting through this with a long-term perspective, or maybe there's some knee-jerk reactions there you might regret in the future? So think about your future you, thinking back to your present you, and reframe that a little bit. And it's an interesting process. I'll kick it over to you to kick us to wrap us up, Nick.
Yeah, whenever you're feeling nervous, you can always go back to the plan that was built, hopefully with your advisor. If you're not one of our clients, if you're one of our clients, you should have a plan. If you're not one, you should get a plan, and that ultimately what will drive what your decision process is. This can be viewed as opportunity. We don't know if the bottom is in, but the market is trading at a discount. And just like you dollar cost average in a 401k, you can dollar cost average in when the market's down. It's kind of counterintuitive that we like to buy things as the price continues to go up, but we don't like to buy things as the price continues to go down when things actually go on sale, because we know at some point in time they're going to go back to full price and the price are going to continue to go up after that. So it sometimes you have to change your mindset and your framework of if you look at this as an opportunity or not. So this is a part of investing. It may not feel good, but we'll get through this. That's why we're trying to have increased communication here. And if you have any questions, if you're one of our clients, please feel free to reach out to one of us. Thank you.
Thanks.